Hello, I'm Anastasia Amoroso, and this is Beyond 60/40. Today, I'm joined by Keith Derman, partner and co-head of infrastructure opportunities at Ares. He shares the new wave of investment options he's seeing in today's market. Then my colleague and investment strategist, Peter Repetto, sits down with iCapital head of structured investment distribution, Peter Horacek, in our Spotlight series, and they discuss the implication of DeepSeek on the outlook for AI and associated with it infrastructure. And then I share the one thing that caught my attention this week in private markets. In today's private market poll snapshot, the one thing I'm focused on is the multi-trillion-dollar investment opportunity in infrastructure and the growing role of private capital in meeting this demand. For decades, infrastructure investing has been synonymous with government-funded highways, airports, and utilities, but today that is changing. Aging infrastructure, the global energy transition, and the recent growth in digital infrastructure, especially around AI and data centers, are creating a new and unique investment opportunity. The numbers, by the way, are staggering. Just to keep up with economic and population growth across the world, we will need an astounding $51 trillion in infrastructure investment through 2040, or that's about $3.2 trillion per year. So what is the exact investment opportunity for private capital investors? Well, for starters, much of the world's infrastructure is aging and is really in a desperate need of an upgrade. In the US, nearly 43% of roads and over 46,000 bridges are in poor condition. And as you can see, most US infrastructure is at or near its useful life. The average age of the US electric grid, 40 years. Water systems, 45 years, though some date back over a century. Oh, and everyone's favorite, the New York City subway, well, that's over 120 years old, and within a decade, nearly 75% of its power substations will be more than 50 years old. And it's not just the US, though. In Europe, 40% of the electric grid is over 40 years old. In Japan, more than 60% of its grid is halfway through its useful life, and much of the physical infrastructure, think roads and bridges, etc., is around 50 years old. So the need for upgrades is obvious and it is urgent. Second, there's the energy transition. The global shift towards renewables is creating, once again, a multi-trillion-dollar investment cycle. Indeed, by 2030, around $4.5 trillion will need to be invested annually in clean energy transition to meet net zero goals. That includes everything from solar and wind farms to battery storage and EV charging stations. And then there's the digital infrastructure, the backbone of today's economy. The growth in cloud computing and artificial intelligence is driving demand for data centers. By 2030, global data center power demand is expected to soar 165%, with the US driving nearly 40% of that growth. To keep up, that means the US will need to double its data center capacity by 2030, or at an equivalent of 3 New York Cities worth of power demand by 2030. But here's the challenge. Governments are facing rising budget constraints and they can't fill this gap alone. So that's where private capital is increasingly stepping in. And over the past 5 years, private infrastructure funds have raised over $625 billion, and they're sitting on $350 billion in dry powder. Now, deal activity has been strong last year, and it is not likely to slow down. The asset class is expected to grow from $1.5 trillion today in AUM to $2.3 trillion by 2029. For investors, this is a major opportunity. First of all, infrastructure continues to deliver strong inflation-protected returns. Over the past decade, for example, private infrastructure has generated an annualized return of 9.6%, far outpacing the global 60/40 portfolio's annualized return of 5.9%, and certainly outpacing the average G7 inflation of 2.5%. And second, the broadening of the asset class into digital infrastructure, for example, means greater growth potential as well. With stable cash flows and powerful secular growth drivers, this space is becoming an increasingly attractive part of private markets. Indeed, here at iCapital, we've seen this growing interest, with 35% of all real asset flows in 2024 directed towards infrastructure funds, which is up from 20% in 2023. Bottom line, the world is undergoing a once-in-a-generation infrastructure transformation, and the governments cannot meet this challenge alone. From aging infrastructure to energy transition to digital infrastructure, the opportunity set today is larger than ever, and private capital is playing a critical role. And that's your one thing in private markets this week. I'm pleased to welcome my first guest today, Keith Derman, partner and co-head of infrastructure opportunities at Ares Management. Over the past 2 decades, the Ares infrastructure team has deployed over $16 billion across more than 350 assets and companies. Keith, thanks so much for joining me today.
Thanks for having me.
It's great to see you, and I'm so excited to have this conversation today about infrastructure. Feels like it's always topical. We always need infrastructure, but I feel like it's particularly timely today given the new administration and given, I would say, very prominent investor focus on it as well. So tell us, why has the asset class attracted as much attention as it has? Why has it grown so much?
I've been an investor in the industry for 20 years now. And when I first got into the sector and we would talk to investors, they didn't know how to categorize us or classify us. And they would say, are you private equity or are you natural resources or maybe you're real estate? And over time that changed. And I think the real big moment was the global financial crisis. Investors were watching maybe the real estate market melt down a little bit, and they were seeing that infrastructure could still get deals done.
Yeah.
There was transaction activity, financings, and the attributes of infrastructure that are so attractive, the lack of correlation to the public markets, the inflation hedge, the income opportunities, the capital appreciation. Investors are drawn to that. That's a great part of anyone's portfolio. And so I really see the GFC as having been that big moment where maybe the sector began to take off.
Yes, and investors are clearly drawn to it because today, when I look at the assets under management and private infrastructure funds, it's $1 trillion. And we're not stopping there because when you look at the forecast, the trillion is forecast to go to $2.3 trillion by 2030. That's the forecast, but do you subscribe to that?
I certainly do. We need to invest in the historical, traditional segments of infrastructure just to keep things moving, whether that's highways and airports and roads and ports, but there's just modern wave of new infrastructure, and that's the evolution of the transportation industry. That is the renewable sector. That's continued growth in the power sector. That is the data center opportunity.
Right. And you mentioned the infrastructure investing gap. It is believed to be $15 trillion cumulatively by 2030 is what we would collectively need to spend to actually close that gap. I'm not so sure it's going to come from the governments given the constrained budget deficits. But let's talk about the opportunities. You've spelled out some of them, but where do you today at Ares find the best opportunities within infrastructure?
We are investing in all of the segments of infrastructure, whether it's transportation, social, energy, utilities, power, digital infrastructure. The highest volume of opportunities today that we're seeing really is in the data center markets. This feels like a generational investment opportunity. We're seeing project after project getting announced and getting contracts. So that allows it to attract capital. We see continued growth in the renewable sector, and we're seeing a resurgence of interest in gas generation to continue to support growth in electricity demand.
Let's talk about data centers specifically because, yes, seems to be this critical moment where we really need a lot of data center capacity, but at the same time, it's been a theme for probably the last, 10, 15 years. So have we not built enough? Are the projections not high enough? Do you still think there's upside to be had in data centers?
I think the slope of the forward curve has changed meaningfully. Right, we've been building data centers for a while as we've been digitizing our society, but then along comes AI, and now the data centers that are getting built, they're no longer 10 megawatts or 20 megawatts, right? And the key thing here is that when we talk about the size of data centers, that's power sector nomenclature. How much electricity does it use? Now we're talking about data centers that are 100 megawatts, 500 megawatts, even a gigawatt of power. It's a complete, paradigm shift in how big these data centers are. They're going to power this AI revolution. When does that slow down? We haven't seen it yet. You have, in particular, 4 really big buyers of data centers, and that's Microsoft, Meta, Google, Amazon, that are, demanding these data centers, signing contracts for them. So I think it's going to continue. Ares believes it's going to continue. The market believes it's going to continue. Those companies are being rewarded in the public equity markets for investing in this industry. So it's likely to continue, I think, for some time.
And of course, that means it's the different types of computing power that needs to be put into it. And it's a different type of power requirement to actually make sure those data centers are running. So let's talk about that. And there's 2 ways to generate electricity, which is renewables and kind of the traditional fossil fuels. And the new administration is going to take, obviously, a very different stance towards renewables than the past administration has taken. There's been a lot of deals that have been done around sustainable renewable infrastructure. So what happens to those deals, and do you still see an opportunity in renewables going forward?
We do, right? We need to take stock of the new administration and some of the executive orders that have come out recently. But what we've always said was that there are 3 Ps that drive the growth in renewables, and it's price, policy, and preference. And the price is, right, the cost of renewables. And the reality is wind and solar are the lowest cost forms of electricity generation, even on an unsubsidized basis. So even without the tax credit, then you've got the policy support from federal and state government, and then you've got the preference. And that's the demand from corporations, in particular, the 4 big tech companies that I mentioned before. That's been the biggest driver over the last few years.
So it sounds like that trend is still going to continue because of some of those Ps. But the first executive orders that was signed by the administration was to declare the national energy emergency and really trying to, not that it needed reviving per se, because oil and gas production is already running at all-time highs, but really trying to further support domestic oil and gas production and presumably power generation that uses those gas-powered power plants. So how big of a focus and an opportunity will this be for you at Ares?
It's a huge opportunity. You need to have molecules coming out of the ground and getting moved to the markets, and energy demand is growing. But ultimately, right, what I think the new administration is going to be saying is that they've got to focus on low-cost energy, they've got to focus on energy security, and they've got to focus on national security. And that means domestic production, but it also means harnessing our resources. When you think about, our vast land and the wind and the solar, it has to be part of the solution, much the way we were saying a few years ago during the Biden administration that was so focused on climate, that gas still had to be part of the solution, right? That it was a transition fuel. The transition may have gotten longer because energy demand is going up, but we'll continue to move in that direction.
Right. So Keith, it certainly sounds like there's a lot to do in all these various parts of infrastructure. And, to help us kind of sum this up for our audiences, infrastructure is a familiar asset class, but maybe there's still some misunderstandings about it. Like, what do you think private clients perhaps misunderstand about infra today?
I think that private clients tend to think it's a new investment opportunity. And I would say it is anything but. It is the basis and the building blocks of our society and our economy. We tend to only notice the infrastructure when it doesn't work, right? When something breaks down or reliability is compromised. And I think that sort of underappreciation in our daily lives has probably led to an element of underappreciation with our wallets and some underallocation. And ultimately, you have an asset class that is underfunded, which means capital needs to flow, that can command long-term contracts that give, annuity cash flow streams and income that provide an inflation hedge, that are uncorrelated to the public markets, providing essential services, capital appreciation. When I think about that, I want that in my portfolio, and I think other investors should as well.
That's right. Well, that's why it is a key consideration, and that's why it's such a topical conversation for today. Infrastructure is certainly not a new, but rather a true and tried asset class. And Keith, thank you so much for dispelling some of those misunderstandings and also telling us what's going to drive this $1 trillion asset class to be 2.3 by 2030. Thanks so much.
Thanks for having me.
Hello, I'm Peter Repetto, Vice President of Investment Strategy at iCapital, sitting in for Anastasia on today's Spotlight segment. Joining me for a discussion on the AI landscape is my colleague, Pete Horacek, Head of Structured Investment Distribution at iCapital. Thank you for joining me today, Pete.
Great to be here, Peter. Thank you.
It's been an interesting few weeks with some of the news that we've got out of the AI landscape, specifically as it pertained to DeepSeek and what that meant for the AI theme more broadly speaking. How are you thinking about the space?
First of all, it's an exciting topic, but we came into work January 27th when the DeepSeek news came out. Knew it was going to be a very volatile day, and it really disrupted the AI space for a short period of time. And typically with structured investments, that's good. It's kind of like our Super Bowl came early because that volatility allows advisors to get creative with the type of products they create, with building custom notes. Take advantage of that volatility, strike at maybe better prices than the Friday before, and add some downside protection to the names that they're probably buying and then probably along in their client portfolios. What are you seeing? What are clients asking you?
It's been interesting, right? To your point about all the market volatility, I think it came down to two key things is, wow, DeepSeek made a model for, really cheap. And then two, given that, the efficiency gains and how cheaply they're able to make this model, well, look at all the US companies that just invested billions of dollars into, large language models here in the US. So what does that mean for CapEx forecasts going forward? So I think those are really the two key areas where investors were questioning themselves throughout the rest of that week, just given the news. But Pete, thinking about kind of the structured investment landscape, how are investors really now viewing structured investments and really viewing structured investments for investing towards the AI theme after the DeepSeek news?
Good question. We had later that week, right, all of the firms, really the mega cap AI stocks come out and talk about earnings, and they kind of reiterated their CapEx spending in the space. So the volatility, was there for a couple of days, but with structured investments, they're so flexible, so customizable. It allows investors to really execute an idea. So take that volatility, monetize it. One such note that was built, custom note through iCapital, was what we call a catapult. It's a 5-year note on a basket of semi stocks that had some about 30% deep contingent protection on the note, 5-year note. If it's called in a year, if that basket is at or above the strike levels of that basket, you call that a 20%. If the note lives for another 4 years, it's 150% leverage on the upside.
Given the news and the market movements, I'm assuming you had a lot of client calls or client questions that came in. Maybe talk to me about what some of those conversations entailed, and were there any areas that there was maybe a pickup in client interest because of this market move that we saw?
I think, everybody's long, kind of the Mag 7 names. They all have different ways they're attacking AI, spending a lot of money on AI with CapEx expenditures. And most portfolios are long AI stocks. So again, structured investments really providing an opportunity to get that downside protection, but kind of an ancillary theme was cybersecurity. So we saw another note, which was a long-term note, investors believing that DeepSeek news and just the focus on AI and how much companies are spending on AI would be good for cybersecurity stocks. So this one advisor picked 2 leading names in the space, constructed a note that would provide significant yield, not growth like that first example, with 40 or 50% contingent downside protection on 2 names, leaders in the space that they were really bullish on. But instead of just going long in those names, really constructed a note that really gave them a lot of different components or benefits.
And given some of the market moves we saw, I'm sure that gives them some comfort,
Exactly.
given what could happen in the future. We get a lot of questions on how has your view on AI changed, if at all, and we really don't see a reason to re-underwrite our view on AI. And thinking about some of the key verticals or subsets of the AI theme, we still feel positive on AI semiconductors, AI software, and as well as AI power. And if we think more about the infrastructure part of that basket, really semis and power side, we got the hyperscalers CapEx forecast last weekend, whereas there was a worry that maybe you could see revisions lower to those numbers. They actually increased those numbers on a year-over-year basis. So thinking about how that ties into, the need for more semiconductors or even data centers, right? That
and
demand,
power with nuclear and a lot of client conversations around that as well.
Absolutely. And that demand is expected to double by 2026. So given that those forecasts are still rising, it seems like some of the targets that we have are achievable and, still feel pretty strongly about those themes. So thank you, Pete, today for your great insights. And thank you, Anastasia, for asking us to sit in on today's Spotlight segment.
Well, thanks, Pete and Peter, for this timely discussion about the ongoing opportunity we see in artificial intelligence infrastructure. And we'd like to hear from you. Send us an email at yourquestion@iCapitalNetwork.com and let us know what questions are the top of mind for you and your clients. I'm Anastasia Amoroso, and thank you for joining us today on Beyond 6040. We'll see you next time.